Hey everyone, welcome back to Corporate Decoder, the place where we dissect the financial secrets of the corporate world. And today we've got a report that makes you wonder if they're selling software or wishful thinking. Buckle up. N-able Incorporated, a company that offers cloud-based security and data protection, just dropped their quarterly report. And we're going to dive deep into what it actually means for them and for you. Let's see if this company is on solid ground or just hoping for the best. First off, this is a quarterly report filed every 3 months, giving us a snapshot of how N-able is doing. The big date here is for the period ending the 30th of September 2025. Now, a quick note on the number of shares out there. As of early November 2025, there were over 186 million shares of their common stock. This is important because more shares can mean potentially less value per S-share if the company's overall worth doesn't increase proportionally. Let's dive into the numbers, starting with their balance sheet. This shows us what the company owns and what it owes at a specific point in time. Looking at the 30th of September 2025 compared to the end of 2024, we see their total assets are over $1.3 billion. That sounds like a lot, but let's see what makes it up. A huge chunk of that, over $1 billion, is goodwill. Goodwill is essentially the accounting value assigned to a company's reputation, brand name, customer base, or other intangible assets that are not separately identifiable. It typically arises when a company acquires another company for more than the fair value of its identifiable net assets. In N-able's case, this substantial goodwill indicates they've made significant acquisitions and the value they place on those companies' goodwill is enormous. Then there are intangible assets which total over $69 million. These are things like patents, licenses, and customer lists that have a definite lifespan. The reported value of these assets has actually decreased since the end of 2024, which could mean some of these acquired assets are being amortized. Or perhaps their value has been reassessed. On the other side of the balance sheet, their total liabilities are just under $585 million. This is what they owe to others. A significant portion of that debt is long-term, sitting at over $328 million. This suggests they are relying on borrowing to fund their operations or growth, which can be smart, but also carries risks if interest rates rise or their ability to repay falters. And finally, stockholders' equity, which is what the owners really have after all debts are paid, is just over $813 million. It is good to see equity has grown from the end of 2024, but again, a large part of that growth is from things purchased in acquisitions, not necessarily organic growth. Now let's look at how they've been performing in terms of making money. This is the statement of operations, which shows their revenue and expenses over a period. Their total revenue for the 3 months ending the 30th of September 2025 was about $131.7 million. This is up from almost $116.5 million in the same period last year. That is a real increase, people, a jump of about 13%. And for the first 9 months of the year, revenue hit over $381 million, up from just under $350 million last year. That is over a 9% increase over 9 months. This is good news, showing their core business is bringing in more money. The vast majority of this revenue, over 99%, comes from subscriptions. This is the recurring revenue model, which is generally favored by investors because it suggests more predictable income. It is great that they're growing this area. Speaking of subscriptions, their dollar-based net revenue retention rate is crucial. It tells us how much revenue they're keeping from existing customers, including any upsells or cross-sells, minus any churn or downgrades. A rate of 102% for the period ending September 2025 means for every dollar they had in subscription revenue from existing customers last year, they now have $1.02 this year. That is positive, but it is actually a dip from 105% the previous year. This suggests that while they are growing with existing customers, the pace of that growth from existing customers has slowed a bit. But bringing in that revenue isn't cheap. Their total cost of revenue, the direct costs to deliver their software, shot up by almost 50% for the 9-month period, from about $57 million last year to over $86 million this year. A big reason for that jump is the amortization of acquired technologies, which went from about $1.4 million to over $12.6 million. This directly relates to the acquisition of businesses like Adlumin. It is essentially the cost of those acquired technologies getting expensed out over time. While it is an accounting cost, it reflects the significant investment in those acquisitions. On top of delivery costs, their operating expenses are also climbing. Total operating expenses went up by about $17.8 million for the 3-month period, and a whopping $45.7 million for the 9-month period. Sales and marketing spending alone increased by over $22 million for the 9 months. Companies often ramp up sales and marketing to drive revenue, and Able is clearly doing that, which is expected when you are trying to grow. General and administrative expenses also saw a significant jump of nearly $14 million for the 9 months. This includes things like executive salaries, legal fees, and other corporate overhead. A big chunk of this increase, about $11.6 million, is labelled as transaction-related costs. This strongly suggests they've been busy with acquisitions and integration, which, while necessary for growth, can eat into profits in the short term. And let's not forget the cost of borrowing money. Interest expense net went up both for the 3-month period and the 9-month period. This is directly tied to their debt, and as we saw earlier, they have a substantial amount of long-term debt. They even have to pay fees just for having access to their revolving credit facility, even if they don't use it all. This highlights the ongoing costs associated with their debt structure. So, with all these rising costs, how is their profitability looking? For the 3 months ending the 30th of September 2025, their net income was just $1.4 million. That is a big drop from over $10.7 million in the same period last year. For the 9-month period, they actually reported a net loss of nearly $10 million. A stark contrast to a profit of over $27 million last year. This is a significant red flag. They're bringing in more revenue, but their expenses have outpaced that growth, leading to much lower profits, and in the case of the 9-month period, an actual loss. They do report something called adjusted EBITDA margin, which is a non-GAAP measure, meaning it is not calculated according to standard accounting rules. It was 26.2% for this quarter, down from 32.2% last year. This also shows a decline in profitability even when you exclude certain costs. It is a way for companies to show a more favorable picture. But the trend here is still downward. Let's look at where the cash is actually flowing. For the first 9 months of 2025, they generated over $67 million from operations. That is up from over $53 million last year. This is a positive sign showing the core business operations are still generating cash. However, when we look at financing activities, things get interesting. They used over $37 million in financing activities for the 9-month period, which is more than double the $19 million from last year. A big part of this is due to significant share repurchases. They've been buying back their own stock, spending $20 million in the first 9 months of 2025 alone. While buybacks can signal confidence in the company's future and potentially boost shareholder value, it also means they are using cash that could have been invested in growth or kept as a buffer. As of the 30th of September 2025, they had about $101 million in cash and cash equivalents. This is up from $85 million at the end of last year. It is good they have cash on hand, but considering their debt load and recent profitability issues, it is not an overwhelmingly large amount. One thing that is boosting their overall comprehensive income is foreign currency translation adjustments, which were positive by over $54 million for the 9 months. This means that as the US dollar has weakened against some foreign currencies, their foreign assets are worth more when translated back into dollars. This is a beneficial accounting item, but it does not directly translate to operational success. A major event was their acquisition of Adlumin Incorporated in November 2024. They paid a significant amount for this cybersecurity platform with initial cash stock and deferred payments stretching over 2 years, plus potential earn-outs. This acquisition is a huge part of their growth strategy aimed at enhancing their security offerings. However, it also explains some of the increased expenses and goodwill on the balance sheet. They also acquired SpinPanel BV in 2022, which added to their intangible assets and goodwill. Regarding legal matters, they state that while they are involved in ongoing legal proceedings, the outcome of these isn't expected to have a material adverse impact. However, they do add the usual disclaimer that the outcome is uncertain and could potentially affect future results. When we look at their risk factors, it is a pretty standard list for a growing tech company. They worry about economic downturns, competition, cybersecurity threats, and their ability to manage growth. They also specifically mention the risks related to their spin-off from SolarWinds, including potential tax liabilities. So what does all this mean? Able is clearly in a growth phase driven by acquisitions. They are increasing revenue, which is positive. However, their expenses, particularly those tied to acquisitions and sales efforts, are growing even faster, significantly impacting their profitability and leading to a net loss for the first 9 months of 2025. Their debt levels are substantial, and while they have cash, the declining net revenue retention rate and the overall drop in profitability are concerning trends. The massive goodwill figure suggests a heavy reliance on acquisitions for growth, which carries its own set of risks if those acquired businesses do not perform as expected. In my opinion, Able is at a critical juncture. They've made bold moves with acquisitions, but they need to demonstrate they can effectively integrate these businesses and turn that growth into sustainable, profitable, organic growth. The increasing expenses need to be managed carefully to avoid further eroding their bottom line. Investors will be watching closely to see if they can reverse the profitability trend and improve that net revenue retention. Alright, that is our breakdown of N-able's latest financial filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And be sure to subscribe for more deep dives into corporate financial documents. Don't forget to check out our Discord community linked in the description below for more discussions and insights not found anywhere else. Thanks for watching. See you next time.